Are you in the process of getting a mortgage loan and feeling just a little overwhelmed by all of the mortgage options that you have? I get it. There's a lot to choose from. So trust me, you are not alone. Hopefully, I can explain some of the most common types of loan programs that can help you understand. First, let's talk about conventional loans. These loans are ideal for buyers with strong credit who can put down at least 5%. However, if you're a first time home buyer, you can qualify for a down payment as low as 3%. If your down payment is less than 20%, you are going to need to pay for private mortgage insurance, or PMI as it's commonly referred to. This insurance protects the lender in case you default on your loan and will remain until you achieve 20% equity in your home. Conventional loan programs can be used to purchase primary residences, second homes, and investment properties. In order to qualify for a conventional loan, typically you're going to need a credit score of at least 620 or above. Depending on what your credit history looks like, a much higher credit score may be required.
Then there's the FHA loan. FHA loan programs are perfect for first time home buyers or those with lower credit scores and a higher debt to income ratio. You can put down as little as 3.5%, and FHA is more flexible on credit history. FHA requires an upfront funding fee, and that fee can be paid in cash or financed into the loan. MI, which is very similar to PMI, is required on the loan regardless of your down payment, and it can remain on the loan for the entire life of the loan. FHA loans are intended for owner-occupied primary residences only. However, you can use an FHA loan to purchase a 2 to 4 unit property, rent the other units as long as you occupy at least one of the units.
VA loans are for veterans, active military, and their surviving spouses. There's no down payment, no PMI, and great terms if you qualify. VA does require a one time upfront funding fee that can be paid in cash or financed into the loan. The amount of that funding fee is going to depend on several factors, such as whether the borrower is a first time or subsequent VA user, the type of the VA loan, the down payment, or whether the veteran is exempt due to a service connected disability. VA loans can only be used to purchase a primary residence. A USDA loan is a government backed program designed to help low to moderate income buyers purchase homes in eligible rural and suburban areas. USDA loans offers 100% financing, competitive interest rates, and reduced MI cost, which makes homeownership more affordable. In order to qualify for a USDA loan, your household income cannot exceed USDA income limits for the county and household size. In addition, you must be buying a primary residence, and the property you are purchasing must be inside a USDA designated area. Also, the debt to income on these loans are typically lower than other types of loans.
Now let's talk about jumbo loans. Jumbo loans are a breed of their own. They are designed for borrowers who are wanting to purchase luxury or high end homes that are priced higher than what the conforming loan limit is for that area, and also that are not eligible for Fannie Mae or Freddie Mac financing. Borrowers typically need to have higher credit scores, often 700 or above, a lower debt to income ratio, and lenders typically require that a borrower have significant cash reserves, which means they want to see that you have 6 to 12 months of mortgage payments in savings. Down payments commonly range from 10 to 20% down, but can be more depending on the lender.
And if your situation doesn't fit in any of the usual loan program guidelines, we do have non QM loans that can help. These types of loans are ideal for buyers who may not meet traditional mortgage guidelines but do have the ability to repay the loan. Examples of some of these buyers would be self employed people, real estate investors, and individuals with unique income situation. There are several different types of loans available. For example, these loans can be done by using a borrower's bank statements, or we can do an asset depletion loan, or if you're looking to purchase investment property, we could do what is called a debt service coverage ratio loan. These types of loans can be used to purchase primary residences, second homes, and investment properties. They typically do require a larger down payment and may have a higher interest rate than your traditional loan program. options. Every buyer is different, and the right loan officer as well as the right mortgage program can make all of the difference in the world. It can mean the difference between a smooth transaction or one that is totally chaotic. At Canopy Mortgage, I have a variety of programs available in house, and if needed, I can broker your loan in order to fit your unique situation. As a certified mortgage advisor, I'm going to review your entire financial picture and I'm going to help you explore all of your options so that you can find the best fit for you and your family. This is the largest type of purchase you're probably going to make in your lifetime, and experience matters. Reach out today. Let's explore your options and see how I can help you. I know you're going to be happy you called.